Today, you're going to hear a complete breakdown of 3 of Singapore's biggest REITs, and they are CICT, MIT, and MPACT. Now, I wish I can cover all the REITs in Singapore. So if you like such content, smash the like button early because you know I have the goods. And press on subscribe so that if I do release more follow-ups in this format, you'll get notified of them. Without further ado, let me share with you today's whole entire format. I'll start with CICT first. I'll give firstly a breakdown. I'll give also a storyline, some updates on their debt situation. A lot of REITs are being sold down because of the increasing interest expense, correct? And last but not least, I'll also give you a hint what to look out for before you pour your money and buy shares of it. So without further ado, let's roll in the intro video. Hi guys, welcome back. Let's start with CICT. A background of CICT is that in November 2020, it was actually a merger between Capital Malls Trust, CMT, and Capital Commercial Trust, CCT. If you were to look in terms of CICT's portfolio, you'll see legacy assets from malls as well as from offices. In terms of malls-wise, it's everything in Singapore, both in heartlands as well as downtown. Downtown include Bugis Junction and Plaza Sing. In terms of offices, you would realize it's mainly focused in Singapore also, other than a few assets in Germany and in Australia. I'll show you interesting findings, so hang on for a while. Let me next show you some interesting storylines about CICT, especially if you're a shareholder already. The mall part is really where I think the growth is coming from. If we see in terms of shopper traffic and tenant sales, it's clear that first quarter 2024 saw increase in numbers, correct? Both suburban malls and downtown malls all saw year-on-year increments. And to understand the resilience of Singapore malls, we can actually refer to this diagram which shows the rent rates have been climbing. The dark blue line on top, which is $36.7 now, is actually the average rate in Orchard Road. As you know, Plaza Singapura is there, correct? So if you're looking to open a shop in Plaza Singapura, do note for 300 square feet, you're expected to pay at least $10,000 already. Then what about the light blue line below? That's actually Suburban Mall, which CICT also owns, and they include Bukit Panjang Plaza. So you'll see that this one is actually more resilient and steadily climbing, correct? I don't know if you agree or not. Orchard Road seems to have less traffic than 10-20 years ago, but every single Heartlands mall seems to be crowded to the brim. That is why also I like Fraser Centreboy Trust, because it's focused on Heartland malls. But with CICT, you get a hybrid and you also get an exposure to office assets. What I also came to realize is CICT doesn't seem to have a lot of acquisitions. The only notable thing of investment seems to be their transformation of Clarke Quay, which I went down very recently to visit. And it's a very new, vibrant place with a big NTUC fair price. I saw a lot of people whining and dining in NTUC fair price itself. Check it out. But this is about the only thing I see notable being added to the portfolio. Let me know if I missed anything from CICT. And let's next move to their debt profile. Over here is a latest screenshot from their first quarter 2024 earnings. You would see that the aggregate leverage is at 40% already. Not in distress, but definitely one of the higher ones amongst the REITs listed in Singapore. Many of them are 30+%. Maybe that also explains why they haven't been making any big acquisitions. Then in terms of average cost of debt, they only charge 3.5% and it's a slight inch up from the previous quarter. I do believe that this would slowly inch up further because if you see in terms of the debt profile, there are some amounts that's going to mature this year, 13% in fact. So once this loan matures, they'll need to do refinancing. But the good part again is CICT is investment grade. This is what I'll suggest to watch out for. In terms of latest performance, we would see that it looks very good on first glance. The retail assets are performing well, the office assets and the integrated development also. If I'm not wrong, that's actually Raffles City. But if we were to compare where exactly are the highest growth areas, it's quite evident that office assets seem to be lagging behind. Yes, it is true that year on year there is growth, like what I boxed up in red, but I'm also showing that in terms of quarter-to-quarter performance, it seems a bit stagnant or flattish. Whereas, if you see in terms of retail assets, there is indeed improvement in terms of gross revenue received. When I dug deeper into the office assets, I realized that Singapore ones seem to be okay, but it's probably the Australian assets, which right now they own 3 of them. 66 Goulburn, 100 Arthur and 101 Miller Street. 100 Arthur Street is right now only at 77% occupancy. When I see around other REITs like Suntec REIT which has office assets, I think Australia seems to be a place where there could be a bit of oversupply. So let's monitor on this for recovery. In terms of the Singapore ones, in this right hand side, rental rates are climbing healthily. If you're curious how to invest in REITs, Hong Kong stocks, US stocks, Singapore stocks, I have a special deal for you. Use Tiger Brokers, who is one of the best trading platforms in Singapore. Right now, they have a max sign-up reward, but I'll touch on the easy one to claim first. If you're new to Tiger Brokers, you'll get an account opening reward of $6 and a special offer using my links below of $30 of fractional shares of Tesla when you deposit a minimum of $1,500. Speaking about earning free Tesla fractional shares, register for free and instantly get a Tiger Boss debit card. You would enjoy competitive FX rates and earn 1% Tesla fractional shares with every transaction. Now, if you have deposited and completed 3 trades, you also receive one lucky draw worth $20 to $600 that could be on Amazon, Apple, Tesla, or Nvidia. If you're okay to deposit $5,000 or more, you get 3 lucky draws worth $60 to $1,800. And if you're looking to deposit $10,000 or more, you get a max sign-up reward of $120 to $3,600. What if you want to trade more? Tiger Brokers also has this new Cash Boost account. With a simplified process, you can open an account in just 3 minutes and start trading without needing to deposit funds. And trade without depositing funds for the full position, with up to 90 days of commission-free contra trading. Look for my links below, and thank you again for supporting the channel. We will next move on to MPACT. A quick background about MPACT. This REIT is actually a merger between MCT, Mapletree Commercial Trust, and MNACT, Mapletree North Asia Commercial Trust. This merger happened in July 2022, and it was brought about by its parent company so that the overall entity is a bit bigger. Long story short, MCT owns mainly Singapore assets, which is VivoCity, Mapletree Business Park, and MNACT owns assets in China, in Korea, and in Hong Kong. The Hong Kong side is where they own Festival Walk, and I don't know if you know this news, Festival Walk actually saw some rioting in November 2019, which caused the share price to plunge because the mall had to stop operation for a period. Imagine VivoCity being vandalized and being overtaken by rioters. What kind of financial impact it does to owners of the property. But it seems that parent wanted, 2 siblings to be closer together because size matters in REITs. But in fact, what we can see is that shareholders of Mapletree Commercial Trust probably didn't like the idea too much. You would see that the share price ran up, correct, all the way until 2020. It came down and then started to recover up. But ever since 2022, you would realize, as in this red arrow, that it's been trending downwards. The lousy sibling is pulling it down. And is it fair or not? I'm also not too sure. What I did is I started investing around 160, 170 range, which is already a discount to what Mapletree has injected at around $2. So why has it been trending down? Let's look at latest numbers. The debt ratio. Currently, MPACT is having a leverage of 40.5%. If CICT is high, this is even higher. So not too good, not much room for major acquisitions. In terms of average debt, it's at 3.35%, even though it's at a lower corporate rating. There is 1+ billion, which is 15%, going to need refinancing this year, which means this weighted average cost of debt will likely inch up a bit further in the next few quarters. Hopefully rental income can recover faster than that, and that's why I'd like to show you what to watch out for. In terms of latest results, it seems pretty good actually on first glance. Gross revenue has increased 2.6%, net property income has increased 3.2%, which resulted in a DPU increment to 2.29 cents. Currently, this is going to give you around 7% in terms of dividend yield. But can it be sustained? Let's answer it with some understanding of its assets. This chart over here is very powerful. And I put this out to show you that Singapore contributes 60% of the net property income. This again is from Mapletree Commercial Trust, where it was once upon a time one of the best REITs in Singapore. The Singapore assets are VivoCity and MBC. And you can see them at the bottom part of the graph, where it's been growing consistently, correct? So no problems from there. When I look at numbers, VivoCity had record traffic, record sales yet again. The surprise factor could come in the yellow one, which is Festival Walk. The purple one, which I've pointed with an arrow, is the China properties. Maybe I'll jump there first to show you that right now occupancy is quite weak. There's still some rental negative reversions down. And although these two are grade A offices in Beijing and Shanghai, from what I read, the Shanghai one is facing a lot of tenancy competition. So this part is not going to recover. If it drops slightly, I think it's a bonus already. So let's go back again to Festival Walk, which I'll explain. The potential recovery comes from visitor arrivals. Festival Walk is located near a border. And as we can see, 2023 was a major jump upwards in terms of visitors, and 2004 even more so. The amount of mainland visitors is the key driver. If we were to analyze 8,006, that could mean around 34,000 visitors, which is a 50% increment and much closer to the heyday. That is why also when we pull at the chart, we would see the net property income's yellow bar for Festival Walk is seemingly recovering. I'll be keeping tabs on this, and if it does well, this could be the big kicker for MPACT. If you don't like Hong Kong and Chinese properties, then go with CICT. This gives you exposure to Hong Kong and China, and you must be comfortable with that risk. With that, let's move on to the third REIT for today, which is Mapletree Industrial Trust. Mapletree Industrial Trust is one of the best performing REITs in the last 15 years. As you can see in this chart over here, it's risen way faster than Singapore Index and the overall REIT Index, especially until the phase of 2020. But what would we see? When you outperform for 5-10 years, you would underperform for the next few years ahead, correct? And personally, that's where I think there's good value. I do expect to outperform again in future, and hopefully I'm right. If you're not familiar with Mapletree Industrial Trust, they currently own assets in Singapore, Japan, and North America. Previously, it was entirely in Singapore, where they own flatted factories, stack-up buildings, and light industrial buildings. But in the last 5 years, acquisitions have moved overseas and mainly into US data centers. So Mapletree Industrial Trust is a data center play. Make no mistake about it. So this graph actually shows the acquisitions they have done along the last 15 years. I'll point an arrow especially to transition towards data centers when it acquired big amounts of properties from its parent Mapletree. They've continuously made purchases of data centers from 2019 all the way to 2023 in the US front. However, of late, there seems to be a change in strategy because the main changes now are firstly, a data center acquisition in Japan and also a building of a project in Kallang Way. This is what you see when you drive along PIE. Before I show you breakdown, let me show you again the DPU growth that Mapletree Industrial Trust has produced. It has been a consistent grower all the way in the last few years, and my personal belief is that the last 2 years of DPU drop may have ended, which also means I'm hoping for 2024 to beat this 13.43 cents at the bottom right. And to beat that, we need a few factors to work. Firstly, the debt, and secondly, the growth in terms of rent, correct? So let me show you next the debt profile. Mapletree Industrial Trust doesn't have too much of refinancing in this year, just a meager 2.5%. The main problem will come in next year only, and hopefully interest rates are a bit more forgiving then. And that's why I think that actually the weighted average all-in funding costs may be able to stay flat for the next few quarters ahead. Currently, the leverage ratio for Mapletree Industrial Trust is at 38.7%, slightly lower than the two previous REITs that we've discussed so far. This is already after the Japanese data center purchase. And while everything seems nice, let me point to some parts to watch out for Mapletree Industrial Trust. Stated on the latest quarterly statement are its good results. Net property income has increased, DPU has increased year on year. But I boxed out something in red that has caught your attention, correct? And that's actually net fair value loss on investment properties. That is actually a downward revision of $210 million. Wow, so not a small amount, correct? And while revaluation is a non-cash item, let's understand where the risk actually is coming from. This is from the data centers in North America. Right now, they've recategorized their segment information to show Japan plus Singapore as data centers Asia and isolate it away from data centers North America. It's quite clear that data centers North America is seeing a drop in revenue. The occupancy rate is dropping over there, and I'm also not 100% sure if the worst is fully over. I will be keeping close tabs on these numbers. The rest of the segments seem to be doing much better. If you see in terms of flatter factories, the year-on-year increment is there. If you see in terms of ramp-up buildings, there is also a growth. And last but not least, data centers Asia, which is Singapore plus Japan, is definitely on the upward trend. The recent Japanese purchase still has legs to contribute further, if I'm not wrong. As mentioned, there's still a final phase to be completed in May 2025 only. And my understanding is that once it's completed, there should be more income, correct? And hopefully that can compensate for the stagnation in data centers North America. Last but not least, I'd like to box up something, which is when they actually issued additional shares at $2.21 for the Japanese data center purchase. This was oversubscribed, which means if you get a chance to purchase Mapletree Industrial Trust at less than 2.21, I think it could be a good deal. Let me know if you agree with it or not, and as always, thank you for watching right at the very end. I'd like to introduce you to this previous video I have touching on why I believe the worst of REITs may be over. With that, sign from here and see you there too. Take care and goodbye.